What's up, Japan Market Samurai? Broadcasting fresh updates straight from Japan. Let me ask you this. You're not blindly holding your semiconductor stocks, are you? Or worse, you're thinking this drop is just another dip to buy without checking the actual reason behind it. Because if you believe this is just a random correction, you're about to miss what the pros already know. They've already shifted their portfolios. Have you? Some might say, only analysts or insiders can understand what's really happening. But here's the truth. You don't need a Wall Street job to make sense of this market. Interpreting market moves is a skill, not a talent. And anyone, including you, can learn it with the right lens. Imagine waking up, glancing at the SOX index, USD JPY, and Nikkei futures, and within 60 seconds, knowing whether to hold, buy, or sell. No panic, no second guessing, just clarity. You feel calm, confident, in control. That's the edge we're building here. Every single video. Maybe you're feeling confused. You saw the Nikkei tank and thought, what the hell is going on? Been there. But if your next move is to scroll Twitter for answers, you're just feeding your confusion. Worse yet, if you think it'll bounce back, it always does, that's not analysis, that's hope. And hope isn't a strategy. But I'm not an expert. I don't have time. I'll just wait and see. Look, those excuses, they're the exact reason why you're always reacting, instead of anticipating. You either choose to evolve, or you stay confused every time the market shifts. I used to be that guy, refreshing charts, hoping things would make sense, until I learned how to zoom out, focus on real drivers, and watch the right indicators. Today, I trade with confidence. If I did it, you can too. It starts with understanding today's Nikkei drop the right way. What I'm about to share isn't guesswork. It's based on hard data. US stocks movements, BOJ policy shifts, global sector rotations. This is the kind of insight most people pay for, but you're getting it here, free. So don't just watch once and bounce. Subscribe now and start compounding your market IQ. Let's dive into what really caused today's 1,000-point drop and what's coming next. Step win. Understand the core driver. It was global, not local. Conclusion. This drop wasn't about Japan. It was a global tech reset. Let's get one thing straight right from the start. The Nikkei's sharp fall today, over 1,200 points at one point, wasn't triggered by anything fundamentally wrong in Japan. This was not the result of a domestic recession, earnings collapse, or policy misstep. The real story? A global-scale tech correction led by the US markets, especially semiconductors. Japan simply caught the aftershock. If you're blaming Tokyo, you're looking in the wrong direction. Reason. The US tech sector sneezed, and Asia caught a cold. Here's what really happened. Last night in the US, the SOX index, Wall Street Semiconductor benchmark, plunged between 2.7% and 4%. That's not a normal dip, that's a significant risk-off move. When the US tech sector corrects, it sends shockwaves through Asia, especially markets like Japan that are tech-heavy. Why does this matter? Because when global fund managers start cutting exposure to semiconductors, they don't care if the company is American, Korean, Taiwanese, or Japanese. They trim across the board. It's sector-level de-risking, not company-specific punishment. And let's not forget, the Japanese market, especially the Nikkei 225, is price-weighted. That means a few big tech names, like Lasertech, Tokyo Electron, and Vantage, can drag the entire index down just by themselves. So when the sector tanks globally, Japan's numbers look worse than they actually are. Example, SoftBank, Lasertech, Tokyo Electron. How the giants fell. Let's look at the actual names that led the plunge. SoftBank Group saw a double-digit percentage drop today. This isn't just about its internal operations. It reflects exposure to global tech trends, especially via investments like ARM and other AI plays. Lasertech, a leader in inspection equipment for semiconductors, also saw its stock price tumble. Investors re-evaluated growth expectations after recent guidance, reinforced that a true recovery in orders won't come until 2026. When sentiment turns risk-off, that long timeline feels a lot further away. Tokyo Electron and Vantage, both deeply embedded in global semiconductor supply chains, were also sold off aggressively. It wasn't about earnings, it was about positioning and perception. Meanwhile, in South Korea and Taiwan, stocks like SK Hynix, Samsung, and TSMC were facing the same fate. This wasn't just a Japan story, it was a coordinated sell-off across the region, triggered by Wall Street. Samurai, ignore the noise. This wasn't a domestic meltdown. So let's be clear. The drop wasn't caused by Japan's economic conditions. It was sparked by a global unwind of AI tech euphoria. US markets led the move, Asia followed. Japan's large-cap tech names magnified the fall because of the index structure. This kind of movement is not about bad fundamentals, but about market psychology and risk sentiment. If you misunderstood the cause, you might also misjudge the next move, and that's dangerous. Now that we've established the real driver, let's move on to step 2, how to separate short-term noise from long-term opportunity. Step 2. Separate long-term growth from short-term valuation. Conclusion. Semiconductors are still the future, but the timing got distorted. Here's the key takeaway. The semiconductor story hasn't broken, it's just being repriced. Investors are not suddenly abandoning the AI revolution. They're simply correcting the speed at which it's priced into the market. In other words, the market still believes in the long-term growth of semiconductors. It's the short-term valuation that's been inflated, and now it's being brought back to earth. So don't confuse a reset with a collapse. They look similar on the chart, but they tell very different stories. Reason markets move too fast too far, and reality is catching up. Let's face it, 2024 and early 2025 were fueled by an AI mania. Every company remotely tied to AI, chips, data centers, automation was priced for perfection. Then came a reality check. When traders realized that demand growth and profit realization would take time, they began unwinding their most crowded positions. That's not panic, it's discipline. And remember, in financial markets, valuation is always a tug of war between expectation and realization. When expectations run too far ahead of fundamentals, a valuation adjustment becomes inevitable. Japan's semiconductor sector, in particular, got caught in this gap. Companies like Lasertech and Tokyo Electron have outstanding technology and global relevance, but their multiples stretch too far. Now, we're simply watching the rubber band snap back to equilibrium. So yes, the long-term growth is real, but the short-term narrative needed to cool off before it overheated completely. Example, Lasertech 2026 Vision and Tokyo Electron's sell the news moment. Let's break it down with two perfect examples. First, Lasertech. Their own management said it clearly. The full recovery in orders and production will likely start in 2026. That's not bearish, it's realistic. But in an AI-fueled market, investors were pricing the company as if the 2026 boom was already here. When that message resurfaced in investor briefings, it triggered disappointment. Not because the fundamentals changed, but because the timeline was re-anchored to reality. Second, Tokyo Electron. The company actually reported strong numbers and even raised its guidance in late October. So why did the stock drop right after? Classic sell the news. The good results were already priced in, and when the overall sentiment turned defensive, profit-taking accelerated the downside. Again, it wasn't a bad business, it was just a case of good story, wrong timing. Both of these examples prove one thing. Investors weren't dumping semiconductors, they were resetting expectations. That's an entirely different kind of move. Someshiri, short-term fear versus long-term logic. Play the right game. So here's how to think like a strategist, not a speculator. The AI megatrend is intact. It's a decade-long wave, not a quarterly fad. What we're seeing now is a valuation correction, not a collapse in fundamentals. Patience and time horizon are the real edge in this market. What we're seeing now is a valuation correction, not a collapse in fundamentals. This is the difference between reacting and positioning. Traders chase noise, investors build conviction. In the short term, yes, semiconductors may face more turbulence, but in the long term, they remain the backbone of digital infrastructure, AI and automation. That's not speculation, that's physics, economics and policy all aligned. Next in step 3, we'll talk about how to use price levels, specifically the 49,000 line on the Nikkei, to identify where correction ends and opportunity begins. Step 3. Watch the 49,000 line. It's the technical lifeline. Conclusion. Watch defend is the level that separates correction from collapse. Let's make this clear. 49,000 yen is more than just a number. It's the technical line in the sun for the Nikkei 225. As long as we stay above 49,000, the market is still in a healthy correction phase. Once we break below it, the risk profile changes completely, and we could be looking at a shift from short-term turbulence to a full-scale downtrend. If you're wondering where the danger zone begins, this is it. That's why this line matters so much. Reason. Price levels reflect collective psychology, not just math. Markets aren't moved by logic, they're moved by emotion, expectations, and narrative. And in technical analysis, certain price levels become psychological anchors. 49,000 isn't just a low from today, it's a recent bottom, a battle zone, and a point where buyers and sellers converge. Why is that so important? Because when a market approaches these critical levels, it reveals true sentiment. If buyers step in at 49,000 and defend it, confidence is still alive. If that support gives way, panic, algorithmic selling, and momentum shorts can accelerate the drop. These levels are also where institutional money decides what to do next. They don't chase candles, they react at key zones. If you're not watching the same levels they are, you're not even playing the same game. And let's not forget the obvious. Round numbers matter. 50,000 and 49,000 aren't just convenient. They're psychological magnets. Traders set alerts around them. Media headlines reference them. Breaking or holding them literally changes the narrative overnight. Example. Today's price action told the whole story. Let's look at how today unfolded. The market opened strong, with the Nikkei peaking at 51,422 yen by 9:01 a.m. But that rally was short-lived. Selling pressure built throughout the morning, and by 11:30 a.m. we had hit the intraday low of 49,073 yen. That's just 73 yen above our critical level. Now here's the interesting part. Despite the heavy selling, the market did not close at the lows. It clawed its way back above 50,000 by the close, settling around 50,220 yen. What does that tell us? The market tested 49,000, but it didn't break. That bounce is a signal. It shows there are still buyers, likely institutional, willing to defend that line. But this also sets the stage for tomorrow. If we retest 49,000 and break below it, the tone changes. Volatility rises. Support turns into resistance. And we could be staring down the next zone, 48,000, which is a vacuum with little technical support. So while today ended with a mild recovery, don't get comfortable. The real battle is still underway. Somerui, respect the level and manage your position size accordingly. To recap, 49 cents is the technical threshold that defines whether this market is in a correction or something more dangerous. It's not just about numbers, it's about crowd psychology, institutional flows, and media narratives. Today's price action suggests support is still there, but fragile. If 49,000 breaks, the next stop could be 48,000 or lower. What should you do with this? Use this level to anchor your risk management. Above 49,000, trade the range, stay patient. Below 49,000, reduce exposure, go defensive, prepare for volatility. In step 4, we'll talk about how to cut through the noise using 3 key indicators, USD JPY, US interest rates, and the SOX index to develop a repeatable framework for spotting trend shifts before they hit your portfolio. Step 4, monitor 3 key indicators to stay ahead of market moves. Conclusion, stop guessing. Use these 3 indicators to see the trend before it hits you. If you're still relying on social media opinions or random headlines to make your next move, you're not investing, you're gambling. The good news? You don't need to be an analyst or economist to understand what's really driving the market. You only need to track 3 key indicators consistently. USD short the yen, interest rates, especially 10-year yields, the SOX index, Philadelphia Semiconductor index. These 3 form a simple, repeatable framework for reading the tone of global markets, especially for Japan, which sits at the intersection of global tech, monetary policy, and FX flows. Once you build this habit, you'll stop reacting to the market and start predicting it. Reason, these 3 indicators explain 80% of short-term market pressure. Let's break down why these 3 are so powerful. USD strength JPY. Yen strength. Japan is an export-driven economy. A stronger yen means overseas profits shrink when converted back to yen. That especially hurts large-cap tech companies with high foreign exposure, like semiconductors. So when the yen rises, Japanese stocks, especially tech, take a hit. US interest rates. Higher US yields signal tighter liquidity, which puts pressure on growth stocks globally. Since tech names are usually long-duration assets, they're the first to drop when rates spike. If you see yields rising, it's often a canary in the coal mine for risk-off moves. SOX index. The SOX index is the heartbeat of global semiconductors. When it drops hard in New York, you can bet Tokyo, Seoul, and Taipei will follow. It's the fastest way to understand the sentiment for anything related to AI, chips, or automation. These indicators are leading signals, not lagging reactions. If you watch them daily, you'll develop market intuition that most retail traders will never build. Example, how today's market drop was fully visible if you are watching. Let's rewind to last night before Tokyo even opened. The SOX index had just dropped between 2.7% and 4% in New York. That was your first red flag. It told you that global funds were de-risking semiconductors. At the same time, the BOJ released meeting minutes suggesting a possible rate hike if conditions allow. That gave the yen a small lift. Stronger yen, headwind for exporters, more pressure on Nikkei. And finally, US 10-year yields were rising again, which meant growth stocks, not just in the US but globally, were back under pressure. If you had all 3 of these on your dashboard, you could have predicted that Japan's tech-heavy index was in trouble before the market even opened. No guesswork, just data. Summary, build your radar. Don't rely on noise. To wrap it up, stop chasing headlines. Start tracking the USD JPY, US yields, and SOX index every morning. These 3 indicators give you a lens into currency risk, a pulse on global liquidity, and a direct line into tech sentiment. You don't need complex algorithms or professional terminals. These charts are free, real-time, and incredibly telling. Use them to develop your own early warning system, one that helps you spot potential drops or rebounds before they become obvious. This is how you move from retail investor to informed operator. Now that we've covered the emotional, technical, and strategic layers of this correction, let's wrap up with the final message. Stick around for the closing segment, where we summarize the entire playbook and show you how to level up your portfolio thinking from today forward. Ending summary. This was not a crash, it was a recalibration. Let's bring everything together. What we saw today wasn't a meltdown. It was a necessary adjustment, a cooling off of overheated AI expectations, triggered by global signals. The Nikkei's sharp drop below 50,500 might look dramatic, but the underlying story is much more structured and far less chaotic than it seems. We broke down why it happened, not because of domestic weakness, but because of global positioning shifts, valuation resets, and a stronger yen. And more importantly, we saw that the long-term story remains intact. This moment is a stress test, not for your portfolio, but for your mindset. If you passed, you're already on your way to becoming a smarter, more resilient investor. Vision. Buy Japan now, and your future self will thank you. Here's something most people don't want to hear. Building real wealth takes time, but time favors the informed. Japan is still a sleeping giant in the global equity landscape. Demographics are shifting, corporate governance is improving, capital efficiency is being prioritized, and with AI, robotics, and advanced manufacturing, Japan is quietly positioning itself for a powerful decade. If you start building exposure now, not chasing trends, but identifying value, understanding cycles, and using signals like the ones we covered today, then 10 years from now, you won't be asking, why didn't I buy Japan back in 2025? Instead, you'll be saying, glad I started when things looked uncertain. Uncertainty is your invitation. Discomfort is your signal. The time to act isn't when it feels obvious, it's when it feels like now. Review. What do you learn today? Let's do a quick recap. Today's drop was driven by global tech correction, not Japan-specific weakness. Semiconductors remain a long-term opportunity, but valuations needed to cool. The 49,000 yen level on the Nikkei is a key support. Break it, and sentiment changes. You now have a 3-signal system to cut through market noise. USD JPY, US interest rates, SOX index. If you can master these 4 concepts, you'll stop following the herd and start seeing what's coming before it arrives. If this video helped you understand the market with more clarity, hit the like button. That helps us reach more serious investors like you. And if you want to keep leveling up with daily, first-hand analysis that goes deeper than the headlines, subscribe to this channel now. Every video we post is crafted with insight most people pay for. But here, you get it free, because we believe better information builds better investors. Drop a comment if there's a topic or stock you want us to cover. We read everything, and your input shapes what we create next. Thanks for watching. Stay sharp, stay focused, and I'll see you in the next video. This is Japan Market Samurai, signing off.